Hey, Latoya, thank you for taking this time this evening for this episode. This will be the first time that we're interviewing a loan officer, so I really appreciate you doing this. If you could please tell us a little bit about yourself.
Thank you so much for having me. As you said, my name is Latoya Goodwin Gary. In some worlds, I go by Gigi, and other worlds, I just go by Gary. I am a mom of a almost 9-year old and an almost 3-year old, a wife, and I've been married to my husband Tony for nearly 16 years. Yeah,
Wow,
I'm that old.
great.
I am an educator by trade. I was a teacher and an assistant principal for 16 years. My husband and I dibbled and dabbled in real estate investment, and I recently, in the last year or so, became a mortgage loan advisor.
Okay, and so what made you want to become a mortgage loan advisor?
Well, as I mentioned in the question before, my husband and I kind of dibbled and dabbled in real estate investment, and I really liked real estate. I knew I wanted to do something in it. I just didn't know when and how. I spoke with a realtor broker friend, and he's like, "Gee, you are really good with math. Have you ever thought about the mortgage side of real estate?" And I'm like, no, I haven't. But let me look into that. And so I did, and ended up meeting a regional manager, and we had mutual friends, and he kind of took me under his wing and took the test, passed the test, and I've been rocking it out since.
Okay, so there's a state test when it comes to being a loan officer.
Yeah, absolutely. There's actually a national test that every loan officer has to take and pass unless they work for a bank.
Gotcha. Okay, did not know that, and that's definitely something that I guess people that don't know anything about it would take in consideration. So when it comes to being a loan officer, how is a loan officer paid? Is it salary? Is it based off of the loans that you bring in?
Well, most loan officers are commission, but it will certainly depend on who you work for. As I said, most of us are 100% commission. We don't get paid until we close a loan, and the percentage that you get paid is also based on your experience and the lender that you work for. Some loan officers receive a small salary and then commission on each of the loans that they close.
Also, and maybe I missed it, is the amount of commission you get based off of how big the loan is. So if I get $1 million loan, I get a bigger commission.
Right, exactly. So we get paid a percentage. For example, we get some loan officers get paid 1%. So they're going to get paid 1% on $150,000 house, as they would get 1% on $1 million house. So obviously, the higher the purchase price, the more money that we make.
Awesome. Okay. And so what type of loans are available, at you as a loan officer, what type of loans do you provide or advertise to applicants? And I'll start with that question first, and then I'll go to my next question.
Sure thing. So there are the standard, I call them the standard loans. We all offer FHA, your government backed loans, conventional type loans, USDA loans, which are your loans for those that live in a rural area where they're trying to develop those areas. So they're the USDA loans. And then there's the VA loans for people like yourself who have served our country and are veterans from the military. And so those are what we call the traditional type of loans. And most lenders offer those. And then you have what are called non-QM loans. So these are not loans that follow your standard guidelines. These are loans for your investors. These are loans for your self-employed or entrepreneurs whose tax returns don't necessarily show the income that they actually make. So they want to qualify based on the monies that they bring in. So those are called bank statement loans or 1099 loans. So you
Okay.
have those investment cash flow loans, and then you have other portfolio loans for, again, people who have monies, but they may not you have the investor type loans, and other portfolio loans for people who they may not have income. They may not be employed as a W-2 employee, but they are making money from other assets and they want to qualify based on their assets.
And so if I want to qualify based off my assets, I'm assuming it's based off what my liquid assets are. So if I own 10 properties, and yeah, I'm probably going to try to show as much of a loss as I possibly can in my taxes,
Mhm.
then hey, I have 300 grand of equity.
Mhm.
How does that calculate into how much I can
Per-
loan for or purchase?
Mhm.
Yeah.
That's a great question. So it depends again on the loan type that you look at. For example, we have what's called an investor cash flow program. So that is where someone wants to buy an investment property. So we would be looking at that borrower or that buyer's. Of course, we're going to look at their credit score. And then we will also look at the market rent for that investment property. So if, for example, the mortgage on that property is going to be $1,000, if your rent, the market rent in the area is at least $1,000 per an appraisal, not per what the buyer says, but per an appraisal, then we would loan you that money.
Okay, so y'all have
Uh,
the 1% rule as well. Y'all
we
go by
have
the
the
1%
we
rule.
have the one we have the 1% rule. Some who lend to investors have a higher rate, like 1.2. I've heard, but we do have a one. We have a 1% rule. And then we have like a bank statement program. So let's say, for instance, you are self-employed, and you're making money, like you said, you're making tens and hundreds of $1,000s a month or whatever have you. But as you said, at the end of the day, you don't want to be taxed like crazy, so you've written everything off, and so your tax returns don't look like you make as much money. Then we would examine your bank statements for the last 12 or 24 months,
Oh
and we
wow.
would be able to determine your income minus your business expenses, and we would use that income versus your tax returns to qualify you to purchase a home, and that can be an investment property or your primary residence.
And then how much is usually required to put down on a
That
loan
is
type
an
like that?
That is an excellent question. So we do have programs that go up to 90% LTV being your loan to value, which means you would have to put down 10%. Now, that also means that you got to be a little better on the credit side, right? And so our programs will go all the way down to a 640. But if you have a 640, 660, you're going to need to bring about 20% instead. But if you are higher, 700 and above, then you only need to bring 10% for those loan types.
Okay, and again, I want to make sure I'm saying this right. This is the
Yes.
portfolio building
These
loan
are the
types.
portfolio loan types, the non-QM. So on your traditional loan type, so that's a great point to clarify. If you are going to qualify on a traditional loan type, don't worry about 10 or 20%. That can be a significant amount of money depending on your purchase price. If you're going to qualify with a traditional loan type like an FHA loan, you only need 3.5%. If you're going to qualify on a conventional loan type, they have programs, and a lot of people don't know this, but they have two programs called Home Ready and Home Possible, where you can qualify with 3% down. And you can also qualify on a traditional conventional loan with as little as 5% down. Oftentimes, people hear conventional loan type and they think 20% because that's what we learned growing up.
Yes.
That is not true. So
So
you can get a home for as little as 3 or 3.5% down.
so with these conventional loans where it's possible to get 5%, does it have to be my primary home?
It has to be your primary residence. Or actually, that is not true. FHA, it has to be your primary residence. Conventional, it does not have to be your primary residence. But
So
if it's not your
okay.
primary residence, you cannot put down the 5%.
Okay,
Five
gotcha,
percent,
gotcha.
yes. So 5% is if it is going to be the home that you will occupy as your own.
Okay, because I was about to end this interview now and call my loan officer because he's telling me 20% and you telling me five. I was about to hit him up
No, but I can get you 10% though.
for an investment
Yes.
conventional.
Yes.
So that's interesting. So hey, as the funny thing is, the cool thing I like about these interviews,
Mhm.
I learn as just as the audience does because these are not spoken. You know, a lot of things are not spoken. Like I just learned about what's it called when you're reassessing a loan. Like I got a loan. You can't do it on VA loans or FHA loans,
Right.
but you can it's a type of refinance where I can put a whole bunch of money down and it adjusts my mortgage to where now my mortgage is not as expensive anymore. Uh
maybe like to refinance it for a shorter term?
So no, it's not called a refinance. And I know we're going a little bit off. It's not a refinance, but I will definitely put it in the show notes because
Yes,
it's something
get
that's
that
not spoken on a lot.
get the
Yeah.
verbiage for me so that I can see if it's something that we offer at Angel Oak.
Yeah, so pretty much, I just want to be clear. So pretty much, you can say I can go to you, my loan officer, say I want to do such and such, and I have 50 grand. Let's just say I inherited it. I have 50 grand. I want to put down on my house, and I wanted to adjust my monthly mortgage, and it doesn't affect your credit. Like it doesn't look bad on you. It doesn't look like
I
you.
see. So they will do an analysis. They'll take that 50,000, put it toward the principal, and readjust what you have on due on the back end. But I would advise you, if you do have 50,000, to take that 50,000 and break it up into two or three and purchase three investment properties instead.
Of course, but everybody's got different goals, so that's why I was just like, oh, that's kind of cool
Absolutely.
because.
But those cash flowing properties can pay
Oh
for
yeah,
that
for sure. I definitely
a proponent
advocate for
for this.
that.
Yeah.
Yeah, for sure. So, all right. So we talked about FHA 3.5% down. It's got to be primary home. We talked about conventional. You can do 5%. Now, why would somebody want to go conventional and do 5% down, put it to be their primary home versus doing FHA, which is 3.5? Why would I
That
pick conventional?
That is an excellent question. So there are a number of reasons why you might pick conventional over FHA. Well, let's talk about FHA first. FHA is a little more, for lack of a better word, lenient on the credit than conventional.
Okay.
So some borrowers may only qualify for FHA if they're in the lower score range, if they have other blemishes on their credit profile, they may not get approved for a conventional loan. But as you said, why would I choose 5% on a conventional loan versus 3.5% on a FHA loan? Well, that is because of PMI, and that is your private mortgage insurance. Your private mortgage insurance, or your mortgage insurance on an FHA loan, is for the life of the loan. And basically, what you're doing is you are paying the government to insure your loan. They want to make sure that if you were to default, and hopefully you do not, but things do happen, that they are insured and they would receive their monies for the property if you were to lose it to foreclosure. For FHA loan types, that insurance lasts for the life of the loan. When you have a conventional loan type, the private mortgage insurance, there is still PMI. Oftentimes people say, well, for conventional, there is no PMI. Well, that's not true. There's PMI if you put less than 20% down.
Mm.
So if you put down 20%, no PMI. You put down less than 20%, and think about it like this: it's the risk. They're taking a risk by allowing us to borrow 100, 2, 3, however much thousands of dollars. So if you put down 20%, they feel a little good about themselves, right? Oh, he came with 20%. We don't need to insure this. We feel a little confident. Well, he's putting down 3 or 5%. We need to insure our loan. So the conventional loan will be insured as well. However, once you reach 78% LTV, and remember we said that term earlier, loan to value. Once you reach 78% loan to value, the PMI drops off. So you no longer have that added cost in your mortgage. That is one of the main reasons why you would choose a conventional loan type over an FHA loan type. Now, FHA has gotten quite attractive to borrowers who qualify for conventional as well because the rates are so low. So it just really depends on the borrower. Honestly, when a borrower applies with me, I will see if they qualify for FHA and conventional. I will say this will be your mortgage payment with FHA and how much money you need to close. This is how much, your payments will be on a conventional loan type because this is the interest rate, and this is how much you will need to close. This is the one that I think is better than the other, and allow the borrower to choose. Now, again, sometimes the borrower is only qualified at that time for FHA loan type.
Yeah, because of the credit score, more lenient on the credit score.
That's right. They're more lenient on the credit score and also more lenient on the DTI. And so hopefully you'll be able to put in the notes because I'm saying a lot of acronyms here. So the DTI is your debt to income ratio. The FHA is going to be a little more lenient on the debt to income ratio as well. So what is debt to income ratio? Well, it is not anything magic. And I'm actually thinking on doing a video on it because I will have a lot of borrowers who are qualified per their credit score and not qualified based on their DTI. Okay, so how much money do you make pre-taxes, your gross income monthly, as it compares to your debt? And so you want to be somewhere in the 40 to 50% range. And if you're closest to the 50, it's FHA. So you want to be in the 40 to 50% range. You want to, again, take your income, your monthly income, take all of your bills, not your electric, not your water, what shows up on your credit report, credit cards, car payments, student loans, and you're going to take the minimum monthly payment and divide that by your gross income, and you'll get, you know, your decimal or your percentage, and you want to be in the 40 to 50% range.
That's pretty good. That's pretty lenient, actually.
It is pretty lenient, and right now things are lenient, and hopefully, you know, they stay that way, because honestly 40 to 50% is not a lot in the grand scheme of things. So I often have people that say, I can't get $1,000 mortgage, but I can pay a $1,500 rent, and it's because of DTI. It's because of your debt to income ratio.
Maybe it's the
And
Dave
so
Ramsey in me where I'm saying 40 to 50% is a lot.
40 to 50% is a lot in the, you know, but not in the grand scheme of things. But the reason, again, why they do that is because of risk. If something were to happen, if you were ill, if you had extra added bills, you need that cushion, you know, you need that cushion. And that is what the lender is looking for, to make sure if something were to happen, if your car broke down, your child had to go to college, that you have money there. You don't want to overextend yourself. And so that's why, you know, 40 to 50. And since you said that's lenient, it is lenient. There have to be compensating factors for you to be able to go up to 50. I'm not going to lend you money at 50% DTI and a 600 credit score and a bunch of blemishes on your profile, and your mortgage is twice your rent. There are no compensating factors there. But if you have, you know, 50% DTI, but you have a 700 credit score, and you know, your mortgage is going to be 1,000 and your rent was 1,400, those are compensating factors, if that makes sense.
And also something I wanted to add too, because something that's helped Amira and I is when we apply for different loans, it helps that we have the income from the rental properties that we add. So, because I don't want it to just look like I have 2 extra homes out there and I'm just paying a mortgage straight up. We can add that into our debt to income ratio, and that helps us qualify for bigger deals. So that's something else. Because I get asked that for the leases, we get asked for the leases a lot.
Mm-hmm. Yeah. Well, on your investment properties, I won't ask you for any of that. So you just call me when you're ready for your next property.
Okay. Oh, just personal question. Where are you at? What state are you in?
I'm in South Carolina.
So you're South Carolina. Okay, gotcha.
Mm-hmm.
All right. Back to the interview. All right. So, so what's the difference? So I'm pretty sure you get it all the time, and everybody can relate. In the mail, we get this: you've been pre-qualified for these loans, right? And so, what is the difference between being pre-qualified and pre-approved for a home loan?
Getting an offer accepted. Okay, so what do you mean by that? So a pre-qualification, when you get those in the mail, you've been pre-qualified for a car, you've been pre-qualified for a mortgage, you've been pre-qualified for everything under the sun. They are looking at basic information that they can find anywhere. Your income, because I when I work for the state, you can search your income. Like somebody can search me out and know how much I make, right? Because we work for the state, right? We work for the government. And so they've pre-qualified you based on that. Or you applied for a credit card at Lowe's. Lowe's sold your information to some other company, so they know you have a good score. So they've pre-qualified you based on some information that they found on the worldwide net, right? And so, but they haven't done a deep dive. So that is a pre-qualification. A pre-approval is where I am looking at your income. I am looking at your debt. I am looking at your assets. I am looking at your credit. So I have looked at everything. So when people apply with me and they don't give me any documents, I tell them, it looks like you have a good score. Do you want me to go further? Then I need to see your pay stubs. I need to see your bank statements. I need to see your tax returns. So a pre-approval is where we've assessed all of that to make sure that you, when you go into underwriting, when that other person who's going to make sure that this is a good file looks at it, then you are not just pre-approved, you're going to close on your home. And
Gotcha.
right now, with the market the way that it is, people used to be able to put in an offer on a home with a pre-qualification, or by just simply by putting an offer in on a home. That is no longer, because there are more at this current time buyers than there are homes for sale, and so no one has time for the shenanigans. So they want to see a solid pre-approval before they accept your offer on their home. Because
And
guess what? They had 8 other offers.
I think it's good business anyways. I try to make sure before I even approach my real estate agent, I have the pre-approval so that she knows she doesn't feel like she's wasting her time. I think that's kind of I call loan officers Jeremy. I call him like, hey, look, I'm gonna talk to you first before I talk to Nicole, because I don't want, I want everybody to feel like nobody's wasting their time. I'm sitting there asking for $500,000 homes, and I'm like, come on, Aunt, you only got approved for 400, So
Right. And that's exactly what would happen. We have big dreams, and so you're out here and you're looking at, like you said, $1 million home, but really your budget calls for a $400,000 home. And it's absolutely nothing wrong with that, but it's just
yeah,
being realistic and not wasting their time or yours.
exactly. And this is so I think when it comes to this process, this is the true gut check of, hey, this is where I financially stand, because aside from having a financial advisor or bookkeeper, I would say the loan officer is probably the most into your weedies, or your CPA, the most into your weedies of what's going on in your life financially. And so most people don't have a CPA, at least not when they use all the time. They probably maybe do TurboTax or something like that, get W-2. And then a lot of people don't have financial advisors, but a lot of people buy mortgages, buy homes. And so they're probably like, man, I'm coughing up all this information. And then they get a reality check of, oh, wow, this is what my financial stability is looking like right now.
Yeah, and it's not a good feeling, please, and it's not something that I take lightly. If people are pre-approved, then I am happy to pre-approve them. That's again how I get paid at the end of the day. But if they are not pre-approved, one of the things that I just really pride myself on is educating them on why you're not pre-approved today and what you can do to be pre-approved in 3 months, 6 months, 9 months, 12 months, depending on their situation. One of the things that, a former mentor taught me is that everybody is a home buyer, not everybody is mortgage ready. And so what can we do to get you mortgage ready? It's just not today. It might be 3 months from now. It might be next year. But if you follow the steps, and I think that is one of the things, and I know this is not about me, but of me and the people that I work with and some other lenders that I know that will set us apart from the masses is taking the time to do that. Because I don't know, I remember when I had bad credit, and if I applied for something, they didn't call me and tell me why I wasn't approved for it. 7 to 10 days later, you get a letter in the mail that you're denied, right? And so taking that time to analyze why someone isn't mortgage ready and helping them get mortgage ready is one of the things that'll set us apart.
Yeah, and you build a relationship and they'll remember to call you back. One of my biggest complaints, and I probably said it like in 10 of our episodes, is when it comes to this real estate business, if you are doing better than 90% of people if you just pick up the phone and follow up. Mm-hmm. That's a real estate agent, that's a loan officer, that's a broker, that's a wholesaler, that's anybody. If you either pick up the phone or you call back, follow up, you will do so much better. People will remember you. And so I definitely agree with that concept. And I'm pretty sure it's working very well for y'all, because it's the biggest purchase that somebody probably ever make in their life.
These purchases they'll make in their lives. Exactly. And so we shouldn't take it lightly because of that very fact.
And so with, okay, I'm buying a home. A lot of
Mhm.
people think that, I'm just doing a down payment if I have to, even if I have to. What are the other expenses that come with purchasing a home?
That's a great question. So let's start with the down payment. I didn't touch on USDA or VA loans. In those loan types, you do not have to make a down payment. They are 100% financed. So you don't have a down payment in those loan types. In South Carolina, I partner with SC Housing, and we have down payment assistance for which many borrowers, not all, can qualify for down payment assistance, and they do not have to make a down payment either. And there are other down payment assistance programs in your various states that you may or may not qualify for because there are income limits and there are home purchase price limits. But it's always something to explore, right? And so with that, other than your down payment and your closing cost, because we talked about the market, right? Back in the day, like when I bought my house 10 years ago, my seller paid all of the closing costs
Yeah.
because it was a buyer's market at that time. Right now, it's a seller's market, and very few. Again, I won't try to step into the realm of being a realtor, but in what I've seen in my files, very few sellers are paying closing costs. So you have to have money saved because you're going to need that 3.5% down payment plus your closing cost. And so your closing costs or what you're going to pay your attorney, it is going to be your taxes, it is going to be your homeowner's insurance, all of that rolled up into one big old fat check, right? So you have your down payment, you have your closing costs. A couple of the things that people oftentimes don't think about, and you need this money before you close, is to get an appraisal. And so the buyer is responsible for the appraisal, and you want an appraisal. You especially want one in this market where people are offering more than an asking price. Because what you want to do is make sure that your house isn't upside down. Isn't that a term with cars? Like you owe more than your car is worth. So you want to make sure you get an appraisal. And depending on where you are, I would say an average of $500. So you
Yep.
need that in advance. And then you want to get an inspection, and an inspection is not required. But my gosh, you want an inspection.
Yes, you
Like
do.
I had a client and she got all of these inspections, but she opted not to get the HVAC inspection at the last before time expired, right? So a realtor will talk about how much time you have to get those inspections done, right? But before that time expired, she said, I should get an HVAC inspection. And lo and behold, the system needed to be replaced. And thankfully, the seller was willing to pay that cost. But had she closed and then the home belonged to her, she would have incurred that cost,
Yep. So
right?
that actually happened to me. The first rental property we purchased, I got an inspection. The home was it's over 100 years old.
Mhm.
And yeah, usually, so in my experience for my home inspectors, they usually charge based off the square footage.
Mhm.
So this home is like 2,500 square foot. So I think he charged me about 400 or 500. And what he found was outside of, right, they take moisture and termite damage underneath the house, which is huge, fungus,
Right,
huge. But
right.
aside from that, he identified that the HVAC system, the people in the neighborhood have been stealing the copper out of
Mm,
the HVAC and
mhm.
were, obviously selling it for whatever they needed.
Right.
And I got lucky to where the seller, he was gracious enough to buy a whole new HVAC system, a
Mhm.
whole new brand one. But yeah, that's real. And HVACs are not cheap. Twelve
And
thousand dollars easily.
right, they're not cheap at all. This was a small home, but still, I think it was $5,000 or $6,000. So, five
Yeah.
or $6,000 that a single mom on a budget didn't have. So, thankfully, that was caught in the inspection. So, appraisals, inspections, and termite inspection are things that I would suggest that you do. Well, you have no choice on the appraisal, but the other things, that I would suggest you be prepared to do prior to closing.
Yes. And then it's good that you get the inspection because when, especially for VA, that appraisal was like so nitpicky.
Oh yeah.
It was
So
so
pay
nitpicky.
appraisals are extremely nitpicky. I can't even speak on this why and what happens and why are appraisal types different, but they are indeed.
Yeah. I was so it's yeah, it just made me think they was going back and forth with me about a shingle, like on one
Yeah,
shingle, going back and forth with me.
a little something. Hmm. Yep.
So so what can somebody expect to be included in their mortgage payment? What is included in a mortgage payment?
That's a great question. So one of the things that always happens is people get on google.com, Google, they're Google queens and kings, and they say, "Oh, I can purchase a house and my mortgage payment will be 553.45." I found that online on the online calculator. Where did you come up with $1,000? Well, most of those calculators are only including your principal and interest. But your mortgage payment includes your principal, interest, taxes, and insurance. So we will estimate your taxes based on the county that you live in, and of course get um, that monthly amount, as well as the insurance. We will estimate that as well, and then you're welcome. The buyer is welcome to get their own insurance quote.
Mm-hmm.
So you will have your principal, interest, taxes, and insurance included in your mortgage payment. And of course, your taxes and insurance go into an escrow account. So they go into a little side account until your taxes are due and your insurance is due annually.
And so that's something nobody has to really worry about until they pay the home off in its entirety, and then they manually have to pay their taxes and
That's
obviously their insurance.
That's exactly right. And so as long as you have a mortgage servicer, so the company that is servicing your loan, Angel Oak, or some one of those other ones out there, then your mortgage payment will include those things, and the servicer will take care of paying the taxes and insurance annually. Once you are free and clear as far as your mortgage is concerned, then you would be responsible for paying that with your insurance company and with your county for your taxes.
And so since we're talking about mortgage, can you explain to everybody what the amortization table is? When they get that in the mail, or they usually get it when you close on a home.
Yeah, so it's just a super complicated looking chart of numbers, right? And so basically, this is another thing that I oftentimes, it's often hard to explain, especially when you're trying to refinance. If someone's been in a home for so many years, let's say they have a 30-year mortgage and they've been in the home for 15, they think I've been in the home for half of the loan time, half of the term, then I should owe 100,000 because my house was 200,000. Well, it doesn't quite work like that. What happens is, again, this is risk, right? The banks are taking a risk by loaning us this money, right, for a home. So they get their money on the front end. So you are paying, when you pay your mortgage in the first 10 years or so, the majority of your money goes to interest and a little bit goes to principal. The majority goes to interest and a little bit goes to principal. And so you have that amortization table. If you look down for all of those months times, 12 months times 30 years, the closer you get to that 30-year, the less you're paying in interest and the more that is going toward your principal.
And
And so you
usually you'll see there was like $5 a month.
Yes, not a lot. And so you have amortization tables for anything that you purchase that has interest, your car, your student loans, those things. That at the beginning, the majority of your money is going towards interest.
And that's something for people to know, because I think that's why some people, they go back and forth between what's better, the 15-year mortgage or the 30-year mortgage. If you're asking a real estate investor, I may say 30 because I get more cash flow. But yeah, I'm paying, a lot interest up front. Or you may ask some real estate investors, well, I want to pay the 15 because I want to have it paid off for 15 years and I'll be retired from it.
Right.
A home, somebody for a primary home, maybe they do want to do the 15-year mortgage so that they have it paid off, but then that almost doubles your mortgage payment,
Right.
which I may not be able to afford.
Right, certainly. And so I rarely get people that want to do a 15-year mortgage, depending on, their debt and their income. But if they want to do it, I will always advise them, here's what your payment will be. This is what the amortization schedule looks like on a 15-year mortgage. And here is what it looks like on a 30-year mortgage. Now, I have a friend who he took a 15-year mortgage, but he also had previously sold a home, was PCS here to South Carolina, took the money that he received from the sale and put it on the new home so that he would only have a 15-year mortgage. But in his thinking, I will retire in these 15 years. So I want to be mortgage free. I want to be debt free. So that is what worked for him. So, you just have to think about your financial situation, your plans for the future, and whether or not you can afford it for 15-year term.
Yeah, because I interviewed a guy, he's 50, and he put his 10 of his properties on 15-year mortgages because he says the last one will be paid off by the time he's 65, which is when he intends to retire from his regular job. Right. So that was his plan, and he was able to figure it out to where he still made money off of it. So yeah, you're right. The type of loan mortgage I pick up is going to be based off of my goals as well as what my finances lay out to be as well.
Absolutely.
Yeesh. There's a lot of big decisions when it comes to the mortgage, because people look at the rent and say, hey, I could pay $1,500 rent, so why can't I be able to pay $1,500 mortgage? And I think you've heard the term house poor. And so people also take into consideration the other things that it takes to have a house, and it's not just paying for the mortgage. It's other, the repairs on you. It's not, it's not on the landlord.
That is very true. However, I don't knock or discourage anybody who chooses to rent, right?
Yeah, for sure.
Rent from me, right? I don't discourage anyone from renting, but I do, if they have a desire to purchase, I will encourage them to do so, because although you are responsible for the repairs when you own your own home, you also cannot borrow from the equity. You can't take the equity out of the home that you rent. You can't pass the property down to your child for the property that you rent. You do not get any tax benefits for the property that you rent. So while there may be more incurred costs initially, or when there is something like a repair, the long-term benefit of owning a home far outweighs that of renting.
And so since we talked about equity, I've never tried to do this with a loan officer. I've only tried to do it with a bank. Do you provide Heloc services?
We currently, I don't know the answer to that one. I do not know the answer to that. That's a very good question, and I don't know the answer. I have not done that with Angel Oak.
Because I'm asking not, for myself and others as well, because that's also something that's not talked about a lot. People using equity within their homes, so HELOC, home equity line of credit. And so a lot of people, right, we hear people use it to buy another car or do upgrades in the house. And I'm big on, I'm not going to take one expense to create another, right? But for people that are trying to invest in something else, I definitely look at you may be sitting on $100,000 and you don't know it because you've been in your home for 10 years, right? And inflation has just happened and homes have just skyrocketed. So you may be sitting on a lot of money and don't know it and can use that money to get started in whatever venture. It doesn't have to be real estate. It could be that barbershop that you wanted to get started in. And so another way of financing is a home equity line of credit, or HELOC. Usually it's somebody, from how it was explained to me, it is not the person that is, or entity that has is the first or the primary person that you own a mortgage to. Is going to be somebody else. It's going to be the second. And the interest rates are higher though. They're higher than they are with mortgages. But if your plan, whatever your business plan is, if it works out to where you'll be able to pay back that HELOC in a timely manner and the interest rate's not going to kill you, then that's something to look into.
I'll definitely see if it's something that Angel Oak offers. And I get why it would be a higher interest rate because, again, it's risk and they would be the second lien and not the first. So that
Yes.
makes complete sense.
Yeah, it's like 7, 8, I guess, depending on your credit, maybe 9. But a lot of people that, the idea is to pay it back within 12 months, 12 to 2 years, 12 months
Right.
to 2 years.
Mm-hmm.
And so so a lot of people don't know this, right? When I go through your company, right, I get a loan, and then not necessarily saying your company does this, but let's say I go through your company, and then next thing you know, I'm talking to somebody else after I got my home as far as what my monthly mortgage payments are. Explain that process when companies sell loans to other companies.
Sure. Well, when companies sell loans to other companies, it should not impact the borrower. It's really not anything about you. You didn't do anything wrong. There isn't anything wrong with your file. Like Angel Oak doesn't want to deal with me anymore. This is a money-making business. Angel Oak, for example, is a capital funds company. So it's about making money. So what they do is take a bunch of loans, they'll bundle them, and then they'll sell them on Wall Street, right? Because they are making interest off of the loan, right? And so when your loans are bought and sold, honestly, your loans may be bought and sold many more times than you know about because it is the nature of the business. The servicer does not even have to let you know if they sold your loan as long as they continue to service your loan.
Okay.
So they may not be the actual lender any longer, but they're the service provider, right? Only when your servicer changes. So let's say, for instance, you were paying your mortgage to mortgagee.com, and now you're going to be paying it to homeloan.com. They have to notify you. Mortgagee has to notify you, company A, and company B has to notify you. Your loan is now going to be serviced by company B. By your payment next month, you're going to be paying with company B now. So that's actually the only time that they are required to notify you that your loan has been sold. Your loan may have been sold many other times prior to then, but only when the service provider changes do you get notification thereof. But it has absolutely nothing to do with you as a client or a borrower. It has nothing to do with your file. It is about making money and interest for the larger companies.
Okay. And so that process when the loan is being sold to the other company, a lot of times, right, people when they buy a home, I don't have to pay my mortgage that first month coming up. I usually don't have to pay for like another 60 days. Why is that?
So that is written in the guidelines that you do not have to make a payment until the first full month after your closing. So oftentimes, and I remember when I first purchased, I didn't know why my lender was saying, we're going to kind of push for, the beginning of the month. That way you don't have to pay your mortgage until the next full month or whatever have you. So, it's just an added benefit. And honestly, I try to do the same thing to kind of give people a little bit of wiggle room before they have to make their mortgage payment, especially if they're moving out of one situation into another.
Yeah, because a lot of people trying to sell one home to get into another, and so it's on a lot of levels. It's a tough transition.
Right, certainly.
So I do appreciate that you've been able to, and thank you so much for your patience. You've been able to break down in detail these programs, these loan programs, and I'll make sure that we put a link to your website, your company's website, so people can go more in depth. And if you have a link that goes directly to you, so that people can go directly to you, contact you, we'll put that in there as well, because these topics are big, because we want people to, when they're talking to a loan officer or talking to a real estate agent, they could be a little educated. I'm not saying you have to be an expert, but at least I know when I call and pick up the phone, I know I have a gist of what you're going to need from me, so that I can be prepared. And I'm not thinking, oh, I just got to put 20% down or 3.5% down and completely forget about inspection, appraisal, and closing costs. And that right there is just that could be another $5,000 on top of the 3.5% I was only saving up for.
That's right. So I always advise to save your money. And even when you don't have money, this isn't something we talked about. And I know that our time is coming quickly to an end. But we did not talk about how you can purchase a home if you don't have all of the cash money for closing costs, down payment, appraisal. Have you worked on your job for 15 or 20 years or 10 years and you have a 401k? You can borrow from it.
Yeah.
The percentage rate and the time that they allow you to pay that back, if it is for a mortgage, is way less than if you were borrowing it for anything else. So you can borrow from your 401k. My mama always told me to have a whole life insurance policy. So if you've had a whole life insurance policy for 18 years, or however long you've been in the workforce, you can also borrow from your whole life insurance policy. It builds cash value. So there are other ways to get access to the monies that you need if you don't have all of it in cash.
No, yeah, you're right. And that has been, I think, the growing trend. People have been talking about whole life insurance and using it because they've been having it for years. Like, again, sitting on money, didn't know it.
Money, and not,
So,
and not.
yeah.
Mm-hmm.
Thank you for adding that. Actually, that's gonna be like the quick tip for the end of it. So, what is your big why? What is your rich state of mind as to why you do what you do? Because it sounds like you have a very diverse career in what you've done throughout your life, and sounds like you've excelled in everything that you've done. So, what is your why as to why you do what you do?
Thank you. So, I've always been a teacher. I was a teacher as a child. I was a teacher as a teacher, and I'm a teacher now. So that is one of my big whys, to educate people. The Bible says people will perish for lack of knowledge. And so anytime that I learn how to do something, if I learn how to teach math, if I learn how to write grants, if I learn how to do investment property, if I learn this much about stocks, I'm sharing it with everybody. And so that is one of my biggest whys, to educate people on this process. I had the numbers in my head, and especially people of color. The gap, the homeownership gap between people of color and our white counterparts is huge. It's larger now than when our parents were our age. So if I can help people gain home ownership, generational wealth, close the wealth gap, that's my huge why. My parents told us to go to college, get debt, because they didn't go to college, right? Get in debt, go to college, and get a job that barely pays you enough to cover the student loans. And so, but not knowing that they lived in their house for 25 years and you can get a Heloc or refinance, or, and pull that money out and invest. So, at the end of the day, I'm going to leave my kids with even more than what my parents were able to leave me, because they didn't have the know-how. And I want to do that and help everybody that I can do that very same thing. Close the wealth gap, build generational wealth, and leave our kids with more than just debt.
And it goes back to what I said. I think like that was the first thing I talked about at the beginning of the interview was exposure, being able to expose our kids to this type of information and content. 15 years ago plus, a lot of this stuff was in libraries. So, and a lot of us won't go in the libraries and going through the books, or just being around people that knew that type of stuff, right? So you're right. People had paid off homes that they bought in the 60s, and it's been paid off for 15 years, and not knowing that they're sitting on an asset that they can do other things with. So that could be a whole nother episode, and we'll talk some more offline at the end of this about those type of topics, because that's why this is important to me, is because of the knowledge and being able to expand the exposure. We're on our phones and on social media more than ever, and so I know that I can get somebody more than likely to maybe listen to a podcast on Apple or on YouTube before I could get them to go to a meetup in the library.
Right.
So,
right. So with that, I'll go to the meetups in the library. I'll go to the real estate investing local groups and get all of the information. If I have to join a podcast, or make an Instagram live video or Facebook video to get the information out there, then that's what we'll do.
Awesome. Well, I appreciate your time, Latoya. It was definitely a pleasure. And we may have to do this again to go more in depth. Thank you for being such like you said, a teacher. That was definitely appreciated.
I appreciate you for having me.